As we're getting closer to year end, I know everybody's busy, but at this time of the year, there's some really key year end topics and conversations that we're trying to have with our clients. And we figured on a beautiful day like this in Carmel, Indiana, we could chat and discuss some of those items together.
So Darin, when you're talking to clients right now, what are some talking points that you like to try to cover and make sure that they're well informed on decisions that they may need to make before the end of the year?
Yep. At this time of year, I always kind of refer to it as the big three that I always bring up and discuss. It's charitable giving, tax loss harvesting, and Roth conversions. So there's lots of different things that we can discuss around those three topics. It doesn't affect everybody. It obviously depends on each person's situation. I would say, if I take a look at tax loss harvesting as an example.
Sure.
Now, it's been a good year in the equity market, so there's been
goodness.
a lot of growth and gains, but one of the things that we'll take a look at from a tax loss harvesting is look through the portfolio in a taxable account. If there are any investments that are currently trading at a loss, what we'll look to do is potentially sell those investments, harvest those losses, so we can use those losses against future gains. So it's just a way to help improve and enhance the after-tax return for our clients.
Right. And you can pair those up against other long-term gains that may have been realized throughout the year. And then understanding there's a $3,000 cap on taking the loss if there's a net loss, right?
Correct, yeah, if there's not enough capital gains to offset it. Right, exactly. And that's where we always want to have the conversation with the client, but also try to bring in their CPA and their tax advisor just to make sure that everything is in sync, especially on the reporting side of things.
Correct. Okay. And then you mentioned Roth conversions. So what are some of the telltale signs of a good idea, like when it comes towards the end of the year? Are you looking at their overall income to see what tax bracket they're in, to maybe if they're in a down year? Is that what you've seen?
Yeah, I mean, there's a lot of nuances that we'll take a look at from a Roth conversion perspective. I mean, it's a complex strategy. I would say it's one of those that it doesn't suit everybody, but there's definitely some things to think about. Like you mentioned about, well, if we think about somebody's income, if we envision and forecast their income being lower now than what we expect it to be in the future, it may make sense to look at maybe taking on some of that income by doing a Roth conversion and then letting the money grow tax-free in a Roth account. The other thing we'll take a look at outside of that would be is if we've experienced major ups and downs in the market. So let's say, for example, we've got a major pullback in the market. Equity markets are down, and we envision there to be a rebound over time. Well, another thing that we can look at is, does it make sense to take those assets that you may have in a traditional pre-tax retirement account while the market's at a low point, convert it to a Roth, so then when the markets hopefully do recover at some point in the future,
it rebounds
we can capture
in a tax-free method.
Exactly.
So another way to kind of piggyback on this is maybe you're in a situation with charitable strategies, and maybe it's a year that you're looking to fund a DAF, a donor advised fund. And they're getting a ton of deductions. That could artificially drive their income down to allow for a Roth conversion.
Absolutely. I think that charitable giving, especially the donor advised funds, things like that can really open the door for some really creative, efficient types of tax planning strategies. Obviously, we want to think about charitable giving in twofold. I mean, first thing is, yes, it's great to give to charity. So we don't want to make this be all about taxes, but if we have a client that is charitably inclined, there's some really cool things we can do, like a DAF or something else.
Right. Well, and it's important to understand how the new tax bill that just came into effect is going to impact charitable giving. There's still going to be the 60% cash and 30% of adjusted gross income limit on appreciated stock, which that's a great strategy as well, is donating appreciated stock. You're not having to pay tax on that gain, and then you get the full benefit of the fair market value of that stock. So that's a good strategy to also look at towards year end. And then as you're going through this new tax bill, you're gonna actually run into a new provision that they put in where they established a new 0.5% floor for charitable giving. So if you have the cash or appreciated stock to stack your donations this year, you can forego that floor that they've recently established.
I'm glad you brought that up. I mean, because they're, especially from a standpoint of selecting securities as part of that, what we're going to look to donate to stock, but also the new tax law. There's a lot of things that need to be thought of and discussed when it comes to charitable giving. And that's where having an advisor, coordination with the different individuals on the team can be really helpful.
Well, and understand their options.
Yep.
You know, I've walked through several different clients here recently, and a lot of them tithe very consistently. Well, we've talked about, hey, do you have the ability to go ahead and put those funds in for next year into a donor advised fund, and you get the benefit now before that floor. And then there's also a new provision next year, even if you don't itemize, you can get $1,000 for a single person or $2,000 deduction for being charitable, and you don't even have to itemize. So that's new for 2026. As we get closer to the year end, have you had any of your clients ask you about high deductible savings accounts?
Yeah, so I mean, HSAs have become really a topic of conversation really over the last several years because they've become more prominent. I've seen more clients that are using high deductible insurance plans where they've got the ability to contribute and invest in an HSA. So one of the things we're talking about with HSAs is that when you make the contributions to it, yes, that money is there for healthcare related expenses, but if you don't necessarily need that money to cover healthcare related expenses, a lot of times you can invest that money within the HSA. So if you are able to invest it, have that money grow tax deferred, you have the ability, once you reach the age of 65, you can start taking that money out. Now you still have to pay tax on it, but you've allowed that money to grow tax deferred.
Right. Well, and here's the fun thing, is this is one of those unique vehicles. It's called with a triple net tax savings. So it goes in tax-free, it can grow tax-free, and under the right circumstances, it can be pulled out tax-free. So in your situation, when you're talking to those clients, and what we've done, and you and I have both done this, and encouraged them to track those expenses that they're paying out of pocket for, because we know that later in life, that is, healthcare becomes such an important item to plan for from a cash perspective. It gets very expensive. So if you can have that tax-free vehicle to be there ready for you in retirement, that's huge. And if you're tracking your expenses that you've paid for out of pocket over the years, then you can match those up on distributions and you don't have to pay tax. It doesn't have to have an expense occurred or paid in that calendar year. It could be 30 years ago, as long as you have that receipt or you have proof of that payment.
That's a great point. So when you're sitting down with clients and talking about HSAs, you guys are having the discussions about thinking through and keeping track of all the healthcare related expense they've had in years prior to be able to use, for example.
Yes.
Okay.
Yeah, and that's just a unique strategy. Now, you have to come up with a good way to track those, but there's a good return on your investment for that time.
So, and we were just chatting about charitable giving, but there's other types of giving strategies that I'm sure other people are considering at this point. Share with me, what are some of the conversations you're having with clients around giving overall?
Certainly. Some of our high net worth clients right now are looking at, they may have a bucket of cash or assets that they know that they need to give as part of their estate planning. Now, I will say that with the new tax bill that just came out, the estate planning sprint at the 1231 cliff is no longer as crazy because they did extend the higher exemptions for the lifetime giving. So for estate planning purposes, it has kind of sizzled down a little bit in that desperation mode. So there's different types of giving. You can cut a check to someone. There's an annual exclusion. A husband and wife can actually split the gift. So they can both give that exclusion to one person. They can give it to the husband and spouse. So for high net worth families, it's really trying to give them the information to make the best decision. Maybe they don't want to max it out, but maybe they do. So we can actually kind of walk them through. And then there are other types of buckets. It may not just be directly gifting. There's a way to pay for tuition directly to an institution, or pay for medical expenses directly to that institution, and then it doesn't count towards that exclusion. There's another new provision from the new tax bill. We're referring to them as T accounts, and those are going to be for minors. So starting next year, you can actually put $5,000 per child into that account, and it can grow tax-free. So it's essentially a retirement account for a child, like an IRA. And then later, when they do become of age, they can take it out for certain reasons, or it can eventually turn into a retirement plan.
I'm glad you brought that up because there's been a lot of questions and that seems to draw on a lot of attention from the new tax bill.
Right. Yeah, and then one other thing about, you know, the giving aspect of it is thinking about the future. So if they've got grandkids, they could contribute to a 529 plan. And for Indiana, for example, you can donate or put in $7,500 and get a 20% tax credit. So it really helps offset some of those higher education costs. And the new tax bill has actually modified some of the rules and the ways that you can actually pull those funds out and use them and not be taxed when you pull them out. So are there any other year-end items? I know we had kind of touched on retirement. How do you like to go about handling that with your clients?
Yeah, because one of the things that kind of gets overlooked at this point in time is retirement plans. I'm talking 401ks, those type of plans like
Certainly.
that. So you want to make sure as you're getting to the end of the year, look back to make sure if you're eligible to maximize those have a year-end deadline to them. Those a lot of times will get confused with IRA accounts where those you have up until the tax filing deadline to put in contributions. So those types of things, just making sure that you've looked over that so you're not leaving any money on the table potentially if you're eligible to do that. So that's one thing that kind of gets overlooked. I know one of the things that you and I were talking about is there's a lot of things out there that affects individuals, but business owners, especially this time of year,
Certainly.
There's a lot of things from a tax planning things that come up when you guys are having conversations. Maybe you could kind of share a little bit more about that.
Yeah, so a lot of what we're doing towards the tail end of the year is, you know, we're looking at net income, you know, and it really depends on the entity type, but a lot of our flow-through businesses, we're looking if they need to pay pass-through entity tax. That's a good strategy, and that really tries to circumvent the cap on the state and local income tax for itemized deductions. And then the new tax bill, and I keep referring to this because there's so many changes that are impacting our clients, but bonus depreciation is back to 100%. This is a great time now for small business owners to really look and see if there's a piece of machinery, a piece of equipment, because they can cut a check for that and write it off immediately. So it is a way to accelerate that benefit of investing in your business. And then that way we can look at, okay, now this is what our taxable income looks like from a business perspective. Is there anything else we want to do? There's different tax strategies around, you know, timing of when you're by paying bills. There's a couple different year-end cash flow planning strategies. But the really important thing though is we don't always want to let the tax tail wag the dog. So at a certain point, you know, there are taxes due. So then we're looking at, okay, what is the bare minimum we have to pay per law, and then make sure they understand what they're going to end up paying or owing January 15th and then 4/15. The important thing to remember too is if you do pay quarterly, 4/15 can end up being a little bit of a sticker shock unless you're walking alongside a financial advisor and your CPA, because that could mean you owe taxes for the prior year and the first quarter of the following year. So just an important thing to remember.
Those are good points. So yeah, there's so much that, you know, we're having conversations with, and that's where we always encourage people that regardless what your circumstance is, whether you think it's very simplistic or you know there's a lot of moving pieces, just having a conversation with your advisor makes a lot of sense at this time of year, because what you don't want to do is you don't want to leave anything on the table or have anything that surprises you like you mentioned.
Right.
Thank you everyone for tuning in. I hope you guys enjoyed this and got something from the content.
And you know, if you have any questions based on what we talked about, our contact information will be provided shortly after this clip.
Thank you.